lost some good sold, which I don't think I did.
Oh, you probably did.
I don't know.
Has anybody done any tax returns since last week? Hmm? Well, try to show up tomorrow as early as possible. Try to show up at least 15 to 4. So when you get booted up, those little people, they show up early. Uh,
Your long lost family, she's called me twice. She has another W-2 that I have to add to her form.
oh, really? That woman that
Mm-hmm.
she going to bring it up or what?
I told her, she's like, can't I do it like over fax or something and send it to you or take a picture and send it to you? I'm like, no, like you just need to make another appointment and come back in.
Why don't you just tell her come in tomorrow? We'll work her in.
I told her, I said, call Michelle down in our office and explain to her what, is going on.
So they do stuff like that. It's a good thing we hadn't e-filed it.
Yeah.
We'll run into all kinds of situations.
She called me twice to give me her, what's it called, checking number,
Routing number.
and she didn't have it either time. And that second time,
We probably could do that. If she would send you a picture of the W-2 on your phone, we could use that.
but she still doesn't know her checking information.
She don't?
No,
She don't know her routing number?
she doesn't know her account number.
Does she not have a check?
Nope.
Well, we're going to have to get her a paper check instead of a. But text her, whatever you do, and tell her to just email you or text you her W-2, and we're going to have to paper file a check if she can't get her routing number.
Well, I don't know what she's doing, so I'll see if she shows up tomorrow.
And if you get a hold of her, if she wants to come in tomorrow, we'll work her in, because seems like we had a little extra time last week. Everything went good. Everybody showed up. Clayton showed up, and so forth. Okay, chapter 14 has AMT in it, alternative minimum tax. I feel like I got to go over it for a few minutes. Review this chapter. We haven't worked any problems. We need to get back to some other chapters. Uh, chapter 11, I guess. See, we did depreciation, didn't we, in chapter 10? Uh, chapter 11 is accounting periods from the tax aspect, and we know a fiscal year and a calendar year and all that, but it has a little more in it than that. Chapter 12, there's more property transactions, trading, receiving boot. That goes along with Schedule D, sale of your home. And chapter 13, uh, section 1231 transactions, and we have inventory in there and so forth. So we have to get back to those chapters, and we should soon have a test, but I don't know when. But alternative minimum tax, just looking at it with you a little bit, if you make a lot of money, all right, but especially if you have depreciation, you may have alternative minimum tax. IRS just allows so much depreciation if you make so much money. Most returns we do here, we'll never encounter this. We'll not encounter it probably at all with the people that we work with. Uh, the formula is you take your regular income tax and you add regular income, not tax, and you add to that tax preference items and subtract adjustments. And anyway, alternative minimum taxable income minus your exemption for AMT. All right, there's a formula in your book. This is from your book also. tax rates and exemptions, 26% on the first 194,000. So see, you got to make quite a bit of money. And always added to your regular taxable income. If you had a lot of, if I could get this work, depletion. Now you only get depletion if the person owned mineral rights, right? If they own coal rights, oil rights, gas rights. And then tax exempt interest on state and local private activity bonds. Well, we always take that out. Bonds issued to operate a state and local government are not preference items. Itemized deductions not deductible for AMT, or they are for our regular tax. State and local income property taxes are not deductible. Home mortgage interest expenses and medical. Difference between regular and AMT depreciation. If regular depreciation is more than AMT depreciation, add the difference. If regular depreciation is less than AMT, subtract the difference. And if you're taking depreciation on personal property, 150% versus 200. All right, I want to get the credits. The only credits that reduce AMT is a foreign tax credit and non-refundable personal credits. What were some of those non-refundable credits? Wasn't your what?
Like the higher education and stuff.
The American Opportunity Credit, education credit, and child credit. None of that's refundable. Credit for the elderly and so on. There's a bunch of them, but the most commonly mentioned. Any AMT paid becomes a tax credit for future years. Taxpayers work for someone else, employer pays their share, but if you're self-employed, must pay both. We know that. We know the rates. We'll get back to alternative minimum tax credit. We know about this. We know about that. We know about doubling the 1.45. That becomes to 2.9. Thresholds, married filing jointly 250, we don't usually have to worry about that. Single 200. Married filing separate is half of 250. Now here's a good picture of refundable credits. How that got over there, but anyway, earned income credit, overpayment of Social Security taxes, sure we get that. Taxes withheld from wages and other income, sure those are refundable, we paid them in. We haven't looked at that. Now, these other credits that are non-refundable, adoption, child tax, dependent care, elderly, education, retirement, and residential energy. Those are all non-refundable. But here's your big one. We know if you pay in more than 7.65 in Social Security, you get the refund on that. That's what they're saying here. You get a refund. Now, how does that work? If you work for one employer made 60,000, you work for another one made 80, they both withhold Social Security. And the threshold may be 130, they withheld too much taxes. The business credit, they also get the energy credit, the handicap excess credit. They do have child care for their employees, rehab expenditures, and research credit, and some miscellaneous credits. We know about this child. Child has to be under 13. Or in Jessica's case, she's an incapacitated dependent, and she can be 21 and her parents still get this child care credit. Or a spouse can be disabled and you can get that credit. So we know about, we don't have to worry about a lot of these limits. We know it's $3,000 per child. Credit for the disabled. Here's why you hardly ever get it. Equal to or more than 65. The credit is 15% of whatever they allow. Tax amount is $5,000, and both spouses disabled. Max amount reduced by non-taxable Social Security, veterans, railroad retirement. That's why they can never get that elderly credit. The adoption credit, we talked about that a while. Jessica, if you ever get married, if you couldn't have children, would you adopt?
Yeah.
And then, of course, your child tax credit is $2,000 per child. That child has to be under what age? It's generally non-refundable. Child has to be unmarried. Credit phases out. If you make over $400,000, we don't have that problem. All right, American Opportunity Credit, you can get $2,500. You're not going into the Lifetime Learning Credit, which is $2,000. That's 20% of $10,000 expenses. 20%. Residential energy credits, it drops at 26%, but it's 30 right now. It does not include more than one home. If you get a credit, you reduce your basis. This is your retirement credit, 10 to 50%, usually 10 to retirement plan up to 2,000 contributions. So 10% of 2,000 would be a $200 credit. Didn't we have that come up the other night on a couple people? I think we did. You got to be 18 years of old, cannot be claimed as a dependent, must not be a full-time student. Foreign tax credits that will be listed. Like I've got some investment with Fidelity, and they may have some investments in foreign stocks. And if I pay a foreign tax, I just put it on my 1040. General business credits, child care, disabled excess, and research activities. They cannot exceed net income or your AMT. Now here's your requirements for earned income. Alexander, can you claim this? Principal bold is U.S. 1.5 a year. You got to be between 20 and 64.
None of us.
Not a dependent of somebody else. If you're married, you must file a joint return. So, Alexander, you can't claim that, can you? Because you're not over 25. Now, this is for a single person, isn't it? I'm not going over the other earned income credit very good. Whew. I didn't mention this. I usually don't have a problem. But anyway, if you paid 90% of this year's tax liability. Now, if my tax liability is $10,000 when I do my taxes, and I have paid $8,000 of that, then I owe a penalty. But now, if I paid 90%, which is $9,000 of that, I do not owe a penalty. When I passed the enrolled agent exam, I'd been owed penalties for the last 2 or 3 years. I had to promise them I would file estimated taxes, pay quarterly taxes, and any other income that I had that wasn't taxable. Mr. Imels is an enrolled agent too. That's a 2-day tax test. I think Sarah is thinking about doing the enrolled agent tax exam. Now, some of you can pass that after having taxes 1 and 2. That certifies you to defend a client all the way up to the Supreme Court. H&R Block cannot defend you unless they're enrolled agents in that company. They can go and hold your hand, that's it. They cannot defend you. But anyway, there's a couple other conditions here. If you annualize it and so on. I think Sarah's going to try to pass the enrolled agent exam. At least she said she was. So all of you got to know Sarah the other night. She does know the program. She does know West Virginia taxes. And she's done VITA for 4 or 5 years. And she's a big help. I just have to watch her about being obnoxious or something. Had to used to tell her about her language. She dropped the F word everywhere, even down to office. I had to get on to her about it. Like one of the faculty members here dropped the F-bomb often. Mr. Imo had to talk to him about it. And it wasn't Mr. Gropin. Or me.
Is it not Missouri?
It's definitely not.
Oh, I didn't say who it was. Could have been Burko.
It's definitely not.
All right, I wanted to review that real quick, but my main view today is chapter 11. Be working even problems on chapter 14. We will get to them sometime. But chapter 11, accounting periods. And once you adopt accounting period, I don't suggest you change it. That's simple. Explain the difference between the cash and accrual method. Now there's a hybrid method. All right, what costs are in inventory? What is the amount of income reported from special accounting methods? All right, Jessica, what is the cash basis of accounting?
I know accrual is what we do all the time. Cash basis is
All right, accrual is what we do all the time. What do we do? I'm sitting here, my legs going to sleep. I'm gonna have to dance.
like you're counting stuff before you actually get it, like accounts receivable and stuff in cash basis. Like you're only like making entries when you actually receive the cash from it.
Okay, Jessica says
If
on
that
accrual
happens.
basis, you count income when it's earned, and you debit accounts receivable.
Yeah.
You may not have the money in 2019, but you count it. And she says on the cash basis, if you don't have the money in 2019, you don't count it. It is that simple. Same with expenses. Now, not many people are on the cash basis.
I just couldn't get it out.
Do what?
Said I just couldn't get it out.
A lot of your small business proprietors, repair people, tax preparers, and even trucking companies, they're on cash basis. All right. Now, a hybrid method is simple. Your accounts receivable and accounts payable or accrual basis, everything else is cash. So if people owe you money, you count it. That's hybrid. If you owe people money, accounts payable, you count it. That's hybrid. Only your receivables and payables makes it hybrid. Quickly, what cost will be in inventory? Now, when I was in the used car business, well, I bought a used car for $5,000. That's usually my cost. But now if I put a $16 sticker on it, if I put a $50 battery on it, I added that to the cost of that automobile. So what are some costs that you add? Accounting methods. Now, if you are, tax accounting methods must be generally the same as the taxpayer's financial accounting method. In other words, if you have a proprietorship, must generally be the same as your financial accounting method, maybe cash basis. They do not have to be the same. It says generally, they do not have to be. Now, accounting methods, we've got a calendar year. That's December 31, January 1, isn't it? All right, we have a fiscal year. Now, if you were in the tax business, you'd want your corporations, some of them have a fiscal year ending on 6/30, so you can keep doing taxes, or even 5/31 or 4/30. Now, if I was starting a business in the last week in December of 2019, I would not do a tax return. I'd wait till 2020 and do a return for 53 weeks. So that's easy to see, isn't it? A C corporation is your main type of corporation. You The other corporation is an S corporation. Now, generally, S, partnerships and personal services, should use a calendar year. Exception, may elect under section 444 a tax year that results in tax deferral of 3 months or less. I don't advise that. If you have a partnership, make it a calendar year. S corporation, a calendar year. Proprietorship, a calendar year. I don't like anyone to have to change accounting period. Then you got to do calculation from 1 year to the next. But you got to have IRS permission if you do change. You got to have a reason why. There is a form, 1128. You may even have to annualize itemized deductions and everything else. Newly married people change year to conform to spouses. Do not marry anybody unless they have a calendar year tax period. And most everybody would. But if they have some kind of funny year, you got to change their accounting period. Couldn't have a change in 10 years. No net operating losses as a result. Short taxable income is more than 90%. No change in your entity status. You're still in a corporation or a partnership. So here's your accounting message, cash. Now, there are exceptions to the cash method. In other words, I pay my rent 3 years in advance. $1,000 a month. That'd be $3,600. Well, that'd be $36,000. All right, if I paid it 3 years in advance. IRS is not going to let you take $36,000 as rent expense in the month you paid it in, or the year you paid it in. So you will have to prorate that rent expense, even though you paid cash for it. Now that's an exception to your accounting GAAP. New taxpayers can pick cash method only available to taxpayers who meet gross receipts. It's available only if you have less than 26 million cost of goods sold. Not a big problem, is it? If no cost of goods sold, the taxpayer can use cash method regardless, even if you were $1 billion company. Does West Virginia have a primary? Do they have a primary for elections? I don't know. Somebody said it was May. I don't know.
I think so.
Huh?
I said I think so.
They probably do. Of course, New Hampshire has one today for the Democrats, and I guess Republicans too. Somebody was asking me when your old state senator would be elected again. Congress people, the United States Congress, is elected every 2 years. Senators every 6. Now, your senator, what's his last name? Joe Manchin, what?
Manchin.
All right, he was elected in 2018. So he has almost 5 years left on his term. That's what they wanted to know. Since West Virginia is 80% Republican, that means 3.5 of you in here would have to be Republicans. The other half would be something else. Anyhow, politics is your own business. Nobody should get mad at you over your politics. Your religion is your own business. Nobody should get mad at you over your religion. Unless you're snake handlers, then I'll be mad at you. Come on, you're not a snake handler, are you? All right. But anyway, look at these figures. Uh, if I put 3 zeros on a number, you know how much it is. Uh, now, if I put 3 more, how much is that? What?
1 billion.
1 billion. 1 billion is 1,000 million. 1,000 million. Now, Bloomberg is worth about 57 billion. He's already spent 300 million, which is nothing, right? According to his assets. Now, our national debt, I'll put on 3 more zeros. What is that?
Trillion.
Trillion. Our national debt, I think, is 20 trillion. Even with Bloomberg's 57 billion, I believe he could stand on a street corner and hand out $1,000 bills as fast as he could until he died, and he wouldn't give it all away. He could probably take $100 bills and stack them to the moon and back. But $1 billion, 57 billion is a lot of money, and especially 20 trillion is a lot of money. It's our national debt. And hopefully you studied about the national debt in economics. Did you? Okay. You can use different accounting methods for different lines of business. Of course, if you own 2 or 3 businesses, you can own different. Now, you must recognize income, any money or property, actually or constructively received. That's what Jessica said. You still have to depreciate and deplete and amortize, even under the cash method. All right, now, prepaid rent. What does that word capitalized mean?
Appreciate.
No. Well, depreciation is capitalizing. Amortization and depletion. They're using the word here in a different perspective. If I prepaid rent $36,000 for 3 years, that means I only take 1 month at a time, 1 year at a time, and they're calling that capitalized, as it is used. I don't like them using capitalized in that aspect. What if I prepaid my interest? If you prepay interest, you can't take it all as an expense in that year. If it's points, you can. All right, if somebody gives you a check, is that the same as cash? Somebody gives you a credit card, is that the same as cash? If I give you a notes payable, that's not good, is it? It's not cash. Probably somebody calling to do a tax appointment. They're funny. Sometimes I can hear their first name. Sometimes I can hear their last name. And occasionally they forget to leave their name. I got one like that this morning. I have to give it, I got the phone number. Occasionally they forget to leave their phone number. And a lot of these older folks, just on the telephone when they're leaving a message, they're nervous. And I had one this morning demanding, I want a VITA tax appointment for this Wednesday at 5:30. No way. She has to get in line. All right, now we're down on the accrual method, which you're familiar with. There's not much change on the accrual method. Income is recognized when earned. Expenses are recognized when owed. Prepaid income recognized when received. All right. So you're going to do a construction job and you get 100,000 up front. What do you have to do with it? Recognize it. Even though you learn about the installment method and you learn about the percentage method, or completion method, or completed contract method. Now here though, you can defer recognition for prepayment of goods, can defer recognition of prepaid for services. Year one, some may be recognized in year two. That would take into account some of those accounting methods. And deduct only if the all advanced test, that means it is an expense. And you have economic performance. If it's a rent expense, you live there a month. If it's labor, you owe for labor. When property or services are actually provided, it meets the performance test. Now let's go to inventories. Now, do you remember the methods of inventory that you had in accounting principles and maybe even intermediate? Have you had inventory and intermediate yet? Possible. Did you have LIFO, FIFO?
Oh, yeah.
Okay, yeah.
Well, you've had it then. All right, lower of cost to market. There is a retail method and a gross profit method. And there is perpetual and there is periodic inventory. And there is weighted average. So a lot of methods. So I'm going to try to bring up real quick a Schedule C. See, we've looked at this a little bit before. You probably filled that one. But once we finish chapter 11, 12, 13, you will have a problem, small business turning. Okay. Now Schedule C, we got gross receipts. Now look at your counting period. What's your options up here? Line N. What's your options?
Cash, accrual, and other.
Other would be the hybrid. All right. Gross receipts, returns, allowance, cost of goods sold. All of your expenses, and you may have to attach to line 27A an attachment. But I wanted to show you the back of the form. Now look at cost of goods sold. We talked about that a minute ago. What inventory methods do you have?
Cost, lower cost for market and other.
All right. Cost is always acceptable. Lower cost to market is always acceptable. Now if you use FIFO or LIFO, you have to explain it. inventory at the beginning of the year, plus purchases. Now, here's two lines that you don't usually have, cost of labor, added onto that inventory, and material and supplies, other costs. Then subtract out inventory at the end of the year, gives you cost of goods sold. Okay? So, this chapter 11 has your cash versus accrual method. It has your inventory methods. Anybody know what UNICAP means? It's some kind of uniform rules, and I don't remember what they were, but it is section 263A in the tax code. You can put overhead into inventory into finished goods. You know you're going to put taxes and rework, scrap, retirement plans. Here are some inventory methods. All right. Jessica, how many of those are you familiar with?
About all of them.
All of them. All right. One real quick review problem. And this is periodic. You begin an inventory. It's 100 units at $1. Purchases 1 is 200 units at $2. Purchases 2 is 300 units at $3. Purchases, if I can get down there, purchase 4 is 100 units at $4. All right, now how many units did I buy? I know.
600.
How much?
600.
1 and 2 and 3 and 1.
You don't count your beginning inventory as purchases.
Right, we bought 600 and we had 1. How many do we have available?
700.
Good. Now, let's say I had 150 in ending inventory. Give me the value of that ending inventory under FIFO. Give me the value of that ending inventory under FIFO. I know it's not pretty, but you can figure it out. FIFO means first in, first out. What units do I have left?
150.
100 at what? But I have 100 left at what? $1 or 4?
At $4.
I have 100 left at 4 and 50 left at what? Now if I reverse that and said this was LIFO,
You have 100 left at 1 and 50 left at 2.
alright. Now that's pretty simple, I hope. And I hope you got a hang on that. How would I have gotten average? I'd add up the units of 700 and the cost of all the units and divided by 700. Now, who do you think uses Pacific ID?
Car makers, jewelry makers,
A what?
like car dealerships.
Yeah, car dealerships. You definitely don't want to go, hey, first in, first out. I sold a $2,000 car, but I can take off 20,000. You know, drugstores,
Jewelry.
car dealers, probably jewelry. Alright, cost or market. If the cost is $2 and the market is 3, or if the cost is $5 and the market is 3. Now, we're getting about the units. Say, what is the lower cost of market right here?
2.
And Ramon, what is the lower cost of market right here?
3.
Alright. I always thought that method was so simple that I could have got a second grader out of the hall, and if they knew what 2 and 3 meant, which they do, they could tell you the answer. Okay, so say you and Ramon passed the second grade test. Alright, long-term contracts. Now we're going to see what IRS accepts on those long-term contracts. And these are the same thing as your accounting methods. But a little bit in principles, but I know you had this one in intermediate, and I know you had this one in intermediate, right? Did you have a modified percent of completion method? That may be new to you. Direct cost, allocated cost, interest expense. You see, anything you divide over different accounting periods, months or years, they're calling it capitalized, because depreciation is over years, capitalized. Look at this other part though. Requiring more than 2 years to complete, and cost is over $1 million. This dormitory down here, they should have it completed in 2 years. It will definitely be over $1 million long. I've not heard exactly. Seems like 10 or 12's ringing a bell, but some homes run up to $1 million. Jessica, when do you think we'll see the new dorm?
Not too long after I'm gone out of here.
And probably your children. But I hope not. I hope it's sooner than later. It would help these international students. It would help people who want to come here from down in North Carolina. We have some. Even in Virginia, it would help people up around Roanoke. West Virginia, it'd help people up around Charleston if we had dorms. Anyway, long-term contracts. Under the completed contract method, costs are capitalized and deducted from revenue when the contract is what? Completed. It might not be completed for 2 years. Costs are placed in work in process until deducted. Work in process until you got to finish good. Now, under percent of completion method, which you all did have, it's reported as work progresses. Alright, revenue recognition. The contract price is $10 million. The current year's cost is $2 million. The expected total cost to build that dorm, let's say, is $8 million. Did you follow? The cost in 2020 on that dorm is $2 million. The total cost is going to be $8 million. The contract price is $10 million to build it. So how much of that revenue do we recognize of $10 million? 2.5. and Jessica just reduced that to 1/4. 1/4 of 10 is 2.5. Now Jessica is one of the few students who don't grab a calculator to add 2 and 2.
Yeah, sometimes I do.
I have principal students who do have a calculator when you want to add 2 and 2.
On the test, I grabbed the calculator, I had to add 28 and 5.
Uh,
Just
Most calculators I went to school were a pen or a pencil. In your brain, I guess some schools may have used a abacus. You know what a abacus is? And then we got up to a slide rule. I never took a math where I had to have a slide rule. Then we came up to calculators, which back in my day, what you have now, Jessica, what kind of calculator do you have?
not a good one.
Is that a scientific or business?
Scientific.
Back in my day, that would have cost at least $300 or $400. Now, 29, 39.
These, right now, I think these are probably about 30, because this is an old model.
Electronics, calculators that went down. Computers that went down in price. TVs that went down in price. But now the services for these things have went up in price, like TV cable, cell phone service. Look back interest. Certain contracts that are more or equal to 1% of taxpayers' average gross receipts for a period of 3 years require a look back to compare the estimated amounts recognized in income versus actual. You just compare an estimated versus actual. You estimated 200,000 of income, but actual is 150. We'll look at that later. We have installment sales. All right, I sold 5 acres of land. I sold 5 acres of land for 20,000. My cost of that land was 12,000. Well, William, that must have been easy. All right, what's my gross profit percentage? Calculate my cost percentage and my gross profit percentage. Selling price is 20 and cost is 12. Help me. Yes, you should have looked at that and got it too. Gross profit's 40, isn't it? Cost of goods sold is 60, isn't it? Right? All right. Gross profit is 40%. 8,000, right? 8 over 20 is 40%. 12 over 20 is 60%. Now, what if I collect 2,000 a year for 10 years? Interest is separate. How much of that do I report as gross profit? What was your gross profit percent? All right. So I report 800 that as income in year one. This installment sales method is easy. Now we do have that on a contract too. form looks more complicated than what I just showed you. This first part, you'll probably calculate gross profit. Selling price 200, right? What's line 6? I don't know if I'm leaving out something there or not. Cost or basis of property 70, depreciation allowed 10, adjusted basis 60, selling expense 13, income recapture 10, add lines 10, 11, and 12. Your basis of your property is 83. 117 is your gross profit. Alright. Contract price is 150. Must be getting 50 down. You're still calculating gross profit, aren't you? But you got selling expenses and commissions and other things you have to add or subtract. Where'd that 78% come from? Would somebody divide 200 into 117? I can't do that in my head.
You do 16, line 16 by line 18.
Well, let me look at it again.
Divide line.
Now that is the, they paid you 50 down. So if you divide 150 by what? Into 16. Divide 16 by 18.
78%.
What percent?
0.78, so 78%.
Alright. So if I get 10,000 next year, my cost of goods sold, wait a minute, was that profit? That was profit, wasn't it? It's 7,800. So these installment contracts are not hard. We won't talk about related party. I just wanted you to see that.
You gotta zoom back out.
I've got a, well, I can do one or two things. So we didn't talk about related party. What does the word, have you seen the word inputted interest before? Now, Jessica, if I sell you something for $100,000, this is a piece of equipment, and I say your payments are even divided by 10 years, you owe $10,000 a year, right? Now, if I say, Jessica, you owe $10,000 a year plus 5% interest, then you owe 5% interest on that first $10,000 for 1 year. The second year, you owe 5% interest for 2 years. The third $10,000, you finally get down that you owe 5% interest for 10 years. That's ordinary interest. That's what we know. But Jessica, if I tell you I'm going to sell you this $100 piece of equipment for $100,000, you give me $10,000 in payments, and there's no interest.
There's no such thing as a non-interest bearing
What?
note.
Yeah. But for IRS purposes and even some other purposes, interest is inputted. Interest is included in that 100,000. Now, in other words, what could you have bought that equipment for at cash price? If you could have bought that equipment for 92,000, then what is it assumed to be your inputted interest? 8,000. Now, if you don't have the cash price, you may have to take the going rate of interest of 5% and divide that 100,000 by 105%. Somebody divide 100,000 by 105%. You got to do that on a calculator. $90-something.
95,238.
The difference would be inputted interest. Okay. Now, if you buy a bond, $1,000 bond for $800, you're going to input it interest. But you're still going to get an interest rate on that bond at whatever bond rate is. And you had to amortize that bond by the interest method in both accounting classes. So you've done that. You've amortized, pretty much inputted interest, but you didn't know what it was. How do you like this one? Tax avoidance. All right, I don't agree with you changing accounting methods, but it does happen. Well, folks, that is chapter. That is chapter 11. Don't look bad, does it say? You should know about inventory. You should know about cash versus accrual, right? Input and interest may sound new to you, but it's easy. Installment method is easy. If you've ever done gross profit and cost of goods sold, you did those in ratios. So there's nothing in chapter 11 that's hard. So reading between now and Thursday, work the evening problems on chapter 14. And I'll see you all tomorrow night at 3:45. Or earlier if you want to get here.
I'm about to be early without
How early?
I'll say about 5:45.
Well, I hope, we're not booked up too bad, so we should be able to let you do that. Things do come up. You don't have a basketball game, do you?
Yeah, that's my game. But I don't got to be there till like 6.
As long as it's just not a date. Another day, Alexander.